Hi everyone and welcome back to the channel. In today's video I'm going to be discussing of the 5 reasons that you need to start and investing in stock today. Now for those who don't know what investing is, I highly recommend to pause this video and to watch this video where I actually explain what is investing and what are different types of investing. Now that everything is clear, this video is dedicated for those that haven't yet started to invest in the stock market. If you still are banking on the interest that you're getting from the bank, this video is for you. So let's start. The first reason why you should actually get into it, because investing is more affordable than you think. Now, like most of us, when we look at a price, let's look at Amazon. Amazon share price is over $3,000, and if you're a beginner and you have $400, $500 or 500 pounds, 500 euros for example, and you might think to yourself, I'm a beginner, I don't have enough money to buy that specific stock. It costs $3,000 or $5,000, whatever the price is. Now the beauty of it is you don't need to buy one full share. You can actually own a fraction of the share. This is obviously one of the resistant barriers that most people have when they're actually thinking of entering the equity or the stock market. So this is not a problem for you guys. You don't need to own one. You can own a 0.00% of one share. It doesn't matter. As long as you own a fraction of the share, you can make money from two ways: from the valuation, so if the price of the stock go up, or if you're able to get dividend. So it obviously will be proportion to how many shares you have. So I hope this is clear. So let's now look at the second reason why you should start and enter the stock market. So the second reason why you should definitely invest in stock is because of inflation. So even if you don't invest in the stock market, your goal should be that to be able to maintain the same buying power for the next few years. Now, all countries around the world has an inflation that's being decided by different monetary policy. So just for this example, let's assume there is a 2% inflation rate. So whatever you're able to buy last year, now you need an additional 2% to buy the exact same product. So this is obviously something you need to obviously consider. So whenever you're saving for the long run, you also need to calculate, or maybe a deduction of your buying power that is actually accumulated for 5 years or 10 years. Now I'm going to show that, for example, in Israel, if you look now at the chart, you can actually see that Israel at some point had a 300% inflation rate. Now for the past few years, it's been fluctuating between, I would say, what, 0.5% to -2%. Now this just to clarify and to visually show you that you cannot count on anything. Inflation can be -%, it can be 5%, it can be 10%. You shouldn't be counting on inflation because it can work in your favor, it can work against you. Now, from what I can see here, like 2020, we had a negative inflation, meaning that for the same product I purchased last year, I need 1.9% less money to buy the exact same product. So in this case, I'm very lucky, but this is not the case in most countries. So this is one reason why you should obviously consider investing in the stock market. So the third reason as to why you should obviously consider investing in the stock market is that investing in the stock market helps to grow your money and your wealth. Now, statistically speaking, investing in stock for the past 104 years have shown that it can generate on average of over 9%. This is a very positive news. Now, for this specific example, I actually took an example of someone that actually decided to invest directly with a bank. So basically CDs or just saving account with a fixed interest. And then another one that actually decided to invest in the stock market. So let's dig in. So in the first screen, we can actually see someone decide to had initial investment of $1,000 and we actually deposited every month $100, and he got from his bank a 0.5% interest rate, which is actually quite generous for some countries around the world. Now he decided to invest for the next 10 years. Now I removed the federal tax rate because obviously every country has different tax rate. Also you need to take that into consideration that at some point also you need to pay some taxes for your income. And obviously you need to take into account the inflation rate. To simplify, I actually put here a 2% inflation rate. So the sum of deposit is $13,000. Now, so from the interest that this person earned is around $386, and the gross future value is $13,386. So after taking into account the inflation rate for the next 10 years, he literally lost 15.5% in buying power and living with less money that he initially intended to have. Now let's look for the same scenario. Somebody actually decided to invest in the stock market. So I actually put here to simplify it on the annual interest rate, because this is what we're expecting on average to make around 9.2%. So I put 9.2% for next 10 years. Now for next 10 years, basically this person has earned over 9.5k in interest. Now when we look at also buying power and everything, inflation, the total increase is 70%. So looking at 10 model, there's two models. You have the model of the saver and you have the model of the investor. For the next 10 years, again, this is simulation. Someone that invests will be better off with buying power compared to someone that actually just keep the money in the bank account. Now on a side note, in most countries, whatever the bank is going to offer you will almost never surpass the inflation rate. So if the inflation rate is 10%, the bank will not be able to give you it 11%. It's always going to be below that inflation rate. So please take that into consideration. So regardless of if you're going to be getting an attractive interest from your bank, it's always going to be below that inflation rate. So it's fundamental to sign with a bank, you're automatically losing money. Alright, so that was the third one, so this was clear. And let's move to the fourth one. Now the fourth one is, you don't need to be an expert. As some people want you to be that you need to become an expert to be able to invest in financial asset. That is not the case. It's as simple as it can be. Yes, there's a lot of variety of investment strategy, but if you're looking at it as from a long-term perspective, it should be just buy and hold. Now, obviously you need to ask yourself, how can I choose the stock? I don't know anything about this company. How can I choose it? Now, there is something called indices or ETF. Those are solutions that basically they group, they literally take the top 10, the top 100, top 500 of all the strongest companies and basically give it a price. So you get basically exposed to 500 companies or 100 companies. Every country around the world have their own local index, okay? Which will give you a great opportunity. Instead of you maybe trying to bet on one company, you can actually bet in a basket of the top performing companies right now. And obviously the local stock exchange will have tendency to review it and to add or remove some companies that are underperforming within the benchmark. So this is obviously a great way for you guys to maybe to break another resistance where you say to yourself, I'm not an expert, I don't know what stock to choose. So this is obviously something that can really help you now. This is the fifth reason, simplicity. Now we all see all these crazy financial videos and films where you see guys with two screen, crazy chart, people panicking. And lucky for us, with all this social media and with all these amazing fintech companies around the world, they have made trading or investing as simple as turning on and off your phone. So it's very intuitive, and there's a lot of support, there's a lot of video tutorial, there's also a lot of information out there for you guys to be able to understand and how to invest. So this is my 5 points. So let me try to summarize it for you guys. So let me do a recap. So we cover fractional, so basically instead of you being able to buy the whole stock, you can actually buy a fraction of it. We also talk about how to maintain a very positive or higher buying power by trying to outsmart or outrun inflation. We also talk about how it makes sense investing in stock, because statistically speaking, for the past more than 104 years, it has been proven that over the long term, you're able to generate more wealth. So we look at average of 9% a year. We also said that you don't need to be an expert in investing. There is many different funds. There's like mutual funds. There's like anything will give you exposure to the top companies in a specific sector. For example, or looking at Dow Jones, for example, or Nasdaq, which is more focuses on the tech industry. And then we have the simplicity. So it's not as difficult as you might think. Please remove the two screen and crazy grab. There's plenty of apps and companies that basically it's very visual, it's very simple. If you know how to use Instagram, YouTube, or Facebook, it shouldn't be as difficult as investing. So I hope that was clear, and stay tuned and watch the next video where I'm actually going to give you the tool that you need to be able to actually more hands-on on investing. So until next time, bye bye.